A fee is basically a payment for a service, a fee is basically a payment for a service rendered, or a good provided, and that's basically what in effect a fee is. For much of recent sort of history, 20th century, we've thought of fees as covering an administrative cost, a specified administrative cost. And so you go to DMV and there's a price for what you have to pay for them providing you a driver's license, right? And it's cover that cost with nominal revenue or profit, right? For the government, it's revenue. For private sector, it's profit. But increasingly, fees have been used as a form of profit stream, right? And that's the material difference, I'd sort of say, in the recent development. So no longer just simply to cover revenue costs or expenses, but it's a form of revenue or actual profit for revenue for government, profit for the private sector. And we see that really take off in the 1970s, 1980s actually. And you may also hear about fees in here or there in terms of airline fees and hotel fees. So my research on fees looks at slightly different, looks at fees primarily in the consumer financial industry, and the rise of fees, particularly in three areas, which are central to upward mobility in America: housing, education, employment, and what gets us from home to school to work, and transportation. And so these four areas are central to upward mobility in post-war America. We also see an incredible rise of fees and related financial expenses in those areas. Let's say student loans, for instance. And again, I'm talking about fees, but fees are part of a larger expense for this student loan. There's a origination fee, and then there are fees which attach to that, delinquency fees if you pay it late. But the student loan itself is designed to pay tuition. And I think that in the UK they call it tuition fees because that's what it is. And so it's a tuition fee. The student loan is designed to offset that cost. So I consider the student loan as a fee. For the average student loan borrower, graduating senior may come out $28,000, $30,000 in debt. Right? Now the argument is put forward, you heard it, that, well, it beats not going to college. Right? But that ignores, and it's misleading because it ignores really the hangover effect that a student loan has. And by being a hangover effect or the cascading effect is, so you're a college student, you're $30,000 in debt, you come out of college. That means you have a worse debt to income ratio, which means you have more points on your mortgage loan, or have to take out mortgage insurance as well. It means that for the next 30 or 40 years of that mortgage loan too, right? You're constantly behind the person who did not have to take out a student loan. So you pay more for your home, you pay more for your car note, and that means that you have less money to save, less equity to build. At the same time too, right? You have a kid, you have a child. The child's born, you want to put money into the 529 college account. You have less investment capital to put in that 529 college account, which means that your child, which also has, again, a deleterious effect on intergenerational wealth mobility. The cascading and hangover effect of student loans is ignored so much by people who want to talk about the advantages of a student loan compared to those who don't have it. Home ownership, higher education, I look at issues of employment, transportation. In every one of these spheres, the key driver is often the financial services lobby or a lobby. Right? And so it's lobbyists who actually write the Garn-St. Germain Act, and the act is basically written, and actually Chicago Tribune sort of says this in their headline, right? This isn't, quote, aid bill for the lending industry. It's actually how they call it. It's not for the consumer. And so lobbyists are crafting these bills. Freddie St. Germain enters into Congress in the late 1960s as a son of a dye factory foreman. Leaves Congress in the 1980s a multimillionaire. You're not supposed to become a multimillionaire as a public servant. This is why he's chair of the Financial Services Committee. And then things really take off. And so lobbyists are driving much of these creative financial products, these fees. Same thing with student lending. Cost-benefit analysis. Someone like a Lawrence Lindsay, economic advisor for Ronald Reagan, staunch Republican, talks about how guaranteed student loans are less efficient than a direct student loan, cost the taxpayer more money, right? Bad financial products, basically. And others talk about it. And both Democratic and Republican administrations do cost-benefit analyses, saying that a direct loan is a better financial product for the student borrower. It gets money more quickly and directly to them. Financial aid officers are saying, wow, this is a streamlined system, right? We can get the money in the hands of our students much faster for less cost, which means that it costs the students less, which means that the students are less likely to go in default or delinquency, which means that the taxpayer is less likely to have to pick up the tab, right? Nevertheless, the direct lending is forestalled and is held off and is basically drowned in a bathtub by a guaranteed student lending lobby. All these things are, driven by by financial services lobby. Same thing with payday lending. Can't get a federal law in part because of financial services lobby. Same thing with the auto insurance, again, which is so critical, which is it's unlawful to drive without it, right? And so with auto insurance, it's the lobby, the insurance lobbies, right? In which in the 1980s, which put more money into a campaign in California to forestall a proposition than was spent in a presidential election that year. Yes. It's the financial services lobby, whether it's insurance industry or student loan industry or banking industry, which allows for the perpetuation of these creative financial products which are so abusive to customers and consumers and which helps to drive wealth inequality in America. Sociologists talk about we're moving toward essentially a majority-minority society. And then we could also talk about women as in terms of the fastest growing consumers in society. And so this demographic population is also have been the ones who've increasingly been the ones marketed and targeted by these consumer financial products, the most essentially most over-leveraged. Whether you talk about subprime mortgages, whether you talk about student loans, whether you talk about payday lending, whether you talk about auto insurance and the ways in which auto insurance is predicated not on merit, but it's predicated on factors not related to the quality of the driver. All these factors have a disparate impact upon the fastest growing segment of society, Latinos, Asian Americans, African Americans, and women. Example of auto insurance, for instance, something which is a boring subject. Who wants to talk about insurance? My gosh, what can be more boring than insurance, right? But nowhere where do you find really the private sector actually more protected than having a good service which is required by law to purchase, but is delivered exclusively by the private sector. Health insurance does not fit that category. There is Medicare, there is Medicaid, right? Only auto insurance has this protected sort of space and class in our society. And so in insurance, auto insurance is in large part determined not by how you drive, but by where you live. It's something called the territory rating system. It's what I call PC profiling, postal code profiling. So it's no longer politically correct or to profile people by gender or race, right? So you can't charge this Latino woman more because she's a woman or Latina, or because she has a Latina sounding name, even though they tried to do that in Texas years back. But you can charge them more based upon where they live, their zip code, their postal code. So PC profiling, politically correct profiling, postal code profiling. And so a Latino woman who lives in a neighborhood which is marked Latina or Latinx, is more likely to pay more in auto insurance for having the same exact driving record. And by saying same driving record, I mean number of years driving. Say they've both been driving 7, 8 years. She has a perfect driving record. She has no tickets. She's not been in any accidents. She drives the same amount of distance. Whereas as a white male who lives in 90210, which is like the most famous zip code, as opposed to a Latinx who lives in a Latin section of California, is still more likely to pay more in auto insurance, even though she has exact same driving profile. Why? Because auto insurance is not predicated upon individual merit, right? It's predicated upon social factors, social environments, where you live, these sort of social factors. And you pay auto insurance 1 year, and you extrapolate this over a 40, 50-year window. So she pays maybe $500 or $600 more in auto insurance in a year. And you extrapolate that by 40 or 50 years life of a driver, and you can see the cumulative amount that this wealth gap pays. I mean, this wealth gap costs the fastest growing population in our society. The future holds. What the future holds is basically that, as I write about, these fees and related costs have a dramatic impact on middle class America, both erecting barriers to the middle class, as well as eroding the middle class as well. But I think sort of looking ahead, as detrimental and as costly, the hidden costs of these fees and related expenses have had upon the middle class, is have even a more damaging and deleterious effect upon the fastest growing segment of American society. People of color are far more likely to have a subprime loan than the average American. Women are more likely to take out a student loan than men. Racial minorities more likely to take out a student loan than the majority of the population, and also be deeper in debt. So in the fastest growing segments of American society, Latinos, women, African Americans, Asians as well, immigrant populations, all of these things I've sort of laid out have had an acute impact upon the fastest growing segment of our society. And so what impact might this actually have, that the fastest growing of society is actually arguably the most over-leveraged of our society? And what might that have on things like public financing, of infrastructure, of retirement savings, of Medicare, and for the state of democracy itself? And so I'm a historian, I write about the past, but looking ahead, looking forward, we have to understand that if we're moving toward ostensibly a majority minority society, and that these things that I've sort of laid out have a disparate impact upon the fastest growing segment of the population, that the future ahead is quite concerning.